Hey my friends, Dr. Barry Burns here with Top Dog Trading. Hope you're having a wonderful day, and today we're going to talk about when to get out of a trade with your stock trading, also futures, also E-minis, and Forex. Anything you're trading, this will work, this applies. So today we're going to talk about getting out of a trend trade, because different types of trades have different types of exits. So the exits are not always exactly the same. So let's talk about trend trades today, and let's get going. So here we see that we have crossed above the 50 MA. This line that turns from green to red is the 50-period simple moving average. I use that as my line in the sand between bull and bear market. We tries to push up, tries to get into bullish territory. Doesn't really work very well. Kind of consolidates here a little bit, and then boom, makes this thrust down. And then we get into a good clear downtrend. So this clears it in. Most importantly, I mean, that cleared at the upside, this clears it to the downside, but it's the retrace you want to look at. So the retrace is weak. In other words, when we get into trend trades, what we're looking for an uptrend, we want strong movement up and weak movement down. So there's a lot of buying for the bullish side, and there's not much selling. It might just be profit taking and very light selling to the downside. We always want to be in the dominant direction of the market where there's the dominant energy. That's the point. Same with the downside. So that's what we have here. See, here we had a strong move up, but then we also had a strong move down. That's not what you want. That is not a good sign for a sustainable uptrend, because this down move negates this up move. It actually completely negated it, completely retraced 100%. Here we had a strong impulse move down and a very small move up. So then we're encouraged to say, okay, this looks like now the dominant direction is down, the sellers are overwhelming the buyers, and that we can get in. That would be a first retrace in the trend. This black line, by the way, is the 15 EMA, and I look for the market to retrace approximately to the 15 exponential moving average on these retraces. And then we get another move down, another move up again, just right to the 15 EMA and holds it, and another move down. Now, 5 waves is what I look for, and I start counting these waves. These are not Elliott waves. I start counting these waves after the market crosses the 50 EMA. I use that as a confirmation of trend. And so it's a little bit of a lagging indicator, but that's when I start counting my numbers. And it's simply making lower lows on the downside. If we're going to the upside, it'd be making higher highs. Now, the average trend, when you count it this way, lasts 5 waves. That's the statistical average. And so once we get into that, I'm looking then to get out during wave 5. W.D. Gann talked about trading being all about the confluence of time and price. And so this also has to do with timing in the sense that 5 waves is average. And then we're going to look at our cycle indicator. By the way, if you're interested in my cycle indicator, I can share that with you. And just send me an email at barry@topdogtrading.com, and I'll show you how to get it absolutely free, and as well as a tutorial on how to trade it. This thing is amazing when you trade it correctly. So during wave 5, that's the time that's optimal to get out of a trend. Now, price and time, I agree with both of those. Let's do something else here, though. So that's time. Let's look at price. So let's bring up a Fibonacci extension, and we'll go from the impulse move we talked about, where it went down harsh and then retraced light, and we're about there, I guess. So yes, so we see we've got this would be what's called your measured move, 100%. There's 200%. Right around 200% is quite often where the market will put in a wave 5. This one goes a little bit further, and that's fine. So again, now you've got the confluence of timing, which is wave 5. Also, the cycle indicator confirms that. You've got your price, time and price, and that comes over to here because we've got the Fibonacci extension. Now, the third thing we're going to add to this is momentum. And down here's our momentum indicator, and this is just the pure momentum indicator. It's a 14-period momentum indicator. And as you'll see, the momentum from here to here had been down pretty good, stayed down below 0. And then when we get into wave 5, it's more shallow. It comes back up to the 0 line. And so that's the third element I look for: time, price, and a momentum shift. Now it's still negative here. It's just weaker to the downside, but it's still bearish. Now if I wanted to take a reversal trade, let's say I wanted to go long at the end of a downtrend, then what I would do is do the same technique, except I would wait until momentum got above the zero line. And because I want bullish momentum. Without bullish momentum, this thing's not going up. That's strength. Because this could go sideways for a while and then develop more strength and continue down and make waves 7, 9, 11, 13, so forth. And that does happen sometimes. So that's not the rule, but sometimes the exception to the rule occurs. So if I'm going to take a reversal trade, which is a lower probability trade, frankly, then I want to make sure that I've got momentum shifting into bullish territory. Now it goes into bullish territory, and then it retraces to the zero line, but does not go down, does not establish bearishness to it. So at this time, I've got wave 5. I've got a retest of it twice. That's our principle of 3 that I talk about. If the market can't break through a support level after 3 tries, usually it's not going to, at least not now, because market participants look at that and say, oh, this price level has failed to break 3 times in a row. Okay, probably not going to happen, and then people actually go the other direction. So that's great. So we've got the rule of 3, we've got a cycle low here, we've got bullish momentum starting to pick up, and it does, it confirms. And then sure enough, now this is an aggressive trade, this is an early trade, you're getting in before the trend is confirmed. Trend's not confirmed until here, but we can use these things to get us in even before it's confirmed. There you go. Now we're back to 1, 2, 3, 4, and so forth. All right. So there you go. That's both how to get out of a trend and into a trend reversal. 2 lessons in 1 today. If you like this video and you're watching it on YouTube, please click on the thumbs up icon below and leave a comment. I love your comments. They really encourage me to create new free tutorials for you. Also, I'm giving away one of my very favorite trade strategies called the rubber band trade. It's a great trade. I take it every time it shows up, even to this day. And it's got a real high win-loss ratio. It's a simple strategy. You can learn it in about 26 minutes. Get the video explaining that trade strategy absolutely free by clicking in the image at the top left corner, or if you're on a mobile device, click on the little eye with a circle around it in the top right corner of this video. And if you're not watching this on YouTube, then there's probably a link below the video or an opt-in form on the side. Once you do that, I'll personally email the video to you.